Everybody, my name is Bennett Tchaikovsky, and welcome. This is part one of my overview of do accounting firms have layoffs? So my disclaimer and copyright notice, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2023 by Bennett Tchaikovsky. All rights are reserved. Any distribution without my prior permission is strictly prohibited. So I got a question, or there was actually, I was holding a pre-meet the firms this past week of September 2023. And one of the students on the call asked a great question, which was, does your firm have layoffs? And a lot of, I think it's not necessarily a misconception, but do layoffs happen with accounting firms? And the answer is yes, but I want to kind of say why that's kind of a last resort for these firms and just kind of talk about how these things happen and everything else that's kind of in between. So and I really felt bad for the recruiter, because as the recruiter and HR professional, this is a very sensitive topic, because oftentimes the human resources person is they're taking directions from management, right? The CEO and CFO or their equivalents, or the managing partner and their head of finance are generally going to be running these firms. And it's kind of like, when you kind of look at this, for HR people, this is kind of a nightmare. No one wants to lay off people. It's much better to, promote from within, develop people, have a happy staff, because when layoffs happen, it's not necessarily a good thing. So we're going to be kind of going through and talking about this is, how do accounting firms make money? And this is really important because this is what drives the hiring of staff. What's involved with bringing on associates into an accounting firm? We'll talk a little bit about other types of non-layoff things, such as performance terminations. And then lastly, we'll kind of talk about layoffs. I am going to make a part 2 to this video, which is going through, like, how do we go through and, avoid, how do we position ourselves? We can't avoid layoffs, but how can we position ourselves to be a stellar employee within an accounting firm? So if we kind of think about it, how an accounting firm starts is, myself as a certified public accountant, I could say to myself, hey, Bennett, I'm going to open my own firm today. And I could form an accountancy corporation. I would have to register it with the California State Board of Accountancy. I'd have to be, because if you're a professional corporation, there's a lot of different steps you have to go through. My bylaws have to have certain words. Only CPAs can be the partners of a CPA firm. There's a lot of rules that kind of go into this. But if you kind of think about it, well, if I started my own accounting firm, I'm doing the work, and all of a sudden I have a lot of business. Well, I'm going to need to hire personnel to help me with my business. And so I'm going to be bringing those people on. And as that kind of evolves, if you kind of look at, the larger firms, is like, why am I mentioning about obtaining and retaining the best clients? Because the clients are why we are here. We're here to service the clients. We're here to basically provide them services, whether it be audit, tax, or consulting. And so the way these accounting firms make money is through engagement profitability. Now, what a lot of times happened in the early 90s, they would use audit, say, as a loss leader. And what I mean by that is they're only going to get like 10% realization on their rates. But as we kind of go through and look at it today, there's a little bit of a different story, just because there tends to be kind of more of a shortage in terms of accountants. But how do these firms make profit? Well, there's going to be a bidding process, right? So depending on the relationship you have, if it's a publicly held company or privately held company, there should be a bidding process where the company who needs the services goes to multiple professionals. And just like a contractor, they're going to say, well, how much are you going to be able to do the work for? And so they'll come back and say, well, we think it's going to be 100,000. Now, when they're looking at this 100,000, how do they bid out the work? Just they kind of think about it like building a house, like, you're building a swimming pool, you're building a casita, whatever you're going to be building, right? Well, how complicated are the books of the business? Is it are the receipts out of a shoebox? Are they using an older version of QuickBooks? Are they just using Microsoft Excel to keep track of things? So depending on all those types of things, that's what's going to really vary in terms of the cost of the engagement. There's also going to be a risk factor. If I'm auditing a publicly traded company, that is a much more heightened risk, right? As an accounting firm, I have to be registered. There's a lot of different factors. So, but when you kind of look at the billings, and I'm just making up these numbers, is like, if I'm going to pay a staff member about $40 an hour, this is roughly 80,000 a year. I know someone say, hey, well, Bennett, what about those extra 2 weeks? So it's like 80, whatever it might be. But I'm going to charge a client like 125 an hour. I'm going to have an associate rate. So when you kind of think about like these billings to the client, and this is really going to be for the accounting staff, right? They sometimes can bill out support staff. It just really depends. But this is how firms operate. They basically are going to hire these accounting professionals, and then they're essentially going to be billing out their services to the client. So again, it's like billing and chargeability, and this is going to be a theme. It's going to come back a little bit later, but this is how accounting firms make money. So you charge the client for a service, the client pays you, we all move on. So people plus perks, creating the best office working environment, right? So this is really about, as far as like, how do firms make money? And I would really say a huge part of this as well, how are your engagements going to be more productive? Do people want to come into work, or do they want to stay away from the office? Well, if they want to come into work and they want to work together and they're motivated together, that's going to create a great office working environment. And by the way, then you're probably going to start getting through your work that much more quickly and that much more efficiently, because people are happy when they go through and work. So, and just kind of remember that engagement productivity is how profitable basically is that firm, right? So when you hear about realization rates, like this is like basically the percentage of their full billing rates that they're going through and realizing. Remember that on certain things, like it might be like bankruptcy work, litigation support, some types of things, those people that are working on that are getting 100% realization. It might be because it's court ordered or something else. But again, there's lots of different ways to go through and to make money. Now, there are costs, right? So, are these, can you don't get to keep all 100 grand. You've got to pay the employees, right? You've got to basically renting office space. You have continuing professional education obligations. So if I'm auditing publicly traded companies, I have to be registered with the Public Company Accounting Oversight Board. And again, I also have costs of like malpractice insurance if I'm hiring assistants. All those are costs that are basically go against this revenue. So when you really look at this, if you have people that are, if I'm billing this out and I'm able to, I have a budget, right? So if I have a staff at 125 an hour, we'll say staff are going to be working on this engagement for 200 hours, right? So if I have the staff that are working on this engagement, well, maybe we'll say it's 400 hours. But if I have that staff, and what if they come in, say at $300, if you kind of look at it up here, not only am I making off the money off the spread between what I'm paying them and what I'm charging the client, but they've actually come in under budget. So it's one of those things where you have to kind of go through and kind of take a look at. And this is why when you're bidding out for a job, it's so important, like, is this client auditable, all those kinds of things. So how do companies make money, right? How do these firms make money? It's by, getting clients. That's really important to remember. And if this will come up later when you're talking about becoming a partner, it's going to be, can you bring in business to this accounting firm? And why is that so important? It's because that's how we're going to be able to hire and basically keep staff. If they have work to do, we can bill them out. We can make money off their time. That's how we're going to go through and make money. So looking at this, by the way, too, there's certain accounting firms that have profit sharing. They'll get bonuses and all those other types of things, but it's really kind of you're looking kind of really at the same goal right over here. So that's kind of the first part over here, is that why, before we even get into the discussion of layoffs, understanding how these accounting firms make money. Now, our staff. Okay, so there's a lot of different ways we can go through and hire people. With accounting firms, or larger mid-size, what they'll want to do is, the great thing about accounting from an educational perspective is that when a student is graduating from a certain school, right, or you're graduating from school, that person can generally be put into the workplace with some knowledge of Excel, and you can train them because they know their basic debits and credits. I've done the reason why my classes, my students will kind of think I'm crazy sometimes. They'll say, Bennett, why are you making us handwrite out all this stuff? It's for a very good reason, because when you get into the employer, you need to understand and know your debits and credits. And I've had that conversation with several different employers where it's like, well, Bennett, they didn't know their debits and credits. They didn't come from you. That's actually my biggest fear as a teacher, is that I'm teaching someone, and when they get to the employer, that's like, I don't know what I'm doing. It's like, wow, okay, I'm really looking bad into the eyes of the employer. So what you kind of see happen is that most accounting firms, again, if they're going to be a little bit larger in size, I'm not talking about the really small firms, they're going to want to hire from the campuses. They want to hire students generally while they're in school, although there are exceptions to that, but they want to hire students while they're in school. They'll go to meet the firms, campus recruiting events. Beyond that, you could look at Indeed, and we'll talk about why you would go to Indeed. Referrals, right? So, and we'll talk about that just in a moment. Internships, right? So an internship, if I'm offering someone an internship, by the way, in accounting, all internships are paid, right? So, but if I'm offering someone an internship, they're going to come and work for me for a set period of time. And so it might be a winter internship if it's a smaller firm, because that's when they have the most work. If it's a big four, it's a summer party, right? I mean, it's not a party, but they're having a good time. And so they're doing their internships over the summer. And so that's a party, right? But they're going through and they're getting, acquainted with the accounting firm, which essentially means that when they hopefully convert to be a full-time hire, they're going to be that much more productive. Okay, so again, going back to this, right? So if I have staff, and if I look over here, well, if I want my staff to be, they need to know what they're doing. So if I have someone who is an intern, by the time they come back into the firm, they're going to know how to write up work papers, do all those other different things. So you have over here these basically different ways. And you can also have direct hires, meaning that they don't do an internship, but they're just hired in directly. Every firm is different. Some firms can only offer internships, so they may be going on more of the direct hire model. Now, in terms of the cost of hiring, right, it's expensive, right? Because when I onboard somebody, and if I'm making a commitment to an employee that's coming in, I'm going to have to train them. Because they don't learn a lot of the things in school. I'm going to have someone mentoring them. Now, it's not going to be official mentorship, but you think about this. If I have a staff member who is billing out at, say, $125 an hour, they have a question about what they're doing. They go to the senior. And they say, hey, senior, I need help with this. And so that's taking away the senior's time from doing their work and to help out the staff. And if the senior is going over the staff work and charging for it, that's essentially going to make their hours go higher on areas that the staff, where the senior may not have been assigned. But that's really a choice by these firms, because look, if I train a staff, you've heard the old thing, if I train a fisherman to fish or train someone to fish, they can catch food forever. It's the same thing here. It's like if I mentor an employee, then that employee will become more productive and do better work for me. So if we look at this from a perspective of mentoring, this will definitely take time away. However, it's a good thing because then my staff are becoming more productive. Now, also too, when you think about these billings, when a brand new staff comes in, they're going to be less productive, meaning that all of a sudden, if I have this $100,000 audit engagement and everybody's brand new, my billings internally may come to $200,000. And so I'm going to have to take a pretty significant loss because I'm not going to be meeting my realization rates. And can I charge that back to the client? Maybe, but the clients, it's like, dude, you gave me an estimate for 100 grand. Now it's 200. And you never came to me during the course of the audit and said it was going to be more. You're absolutely nuts. And so what the firm will generally do is they'll say, okay, we're going to eat it this year because all of our staff were brand new or we had some turnover, and we'll do a better job of it next year. So again, that's when you can actually say productivity losses from the engagement team. That's also another cost because you're developing that staff. Now, the thought is when that staff comes on to the engagement, then their next engagement or the same company the following year, because they've had that time, they're going to be that much more productive. So again, that's a huge deal. Now, when it comes to experienced hires, this is where it gets interesting because I've only really been talking about, the training cost in terms of, bringing on someone brand new. But if you're bringing on, say, like a senior or a manager, right? So if you look at the levels, it's associate. They call them different things. It's like they'll call associate experienced associate. Then it's senior associate. Then it's manager. And it might be then a director. And then it might be, there's all these different fun terms for what we call people. Ultimately, it's a partner. Managing partner is the highest level. But when you're hiring at the senior level or higher, and this is where it gets really expensive. If I go to a recruiter, right, it's going to basically cost me about 30% of their first year wage. If I have someone on retainer, that's still going to be expensive, but not nearly as expensive as going to a recruiter. And finding senior associates that want to work at an accounting firm, and I've heard it called, it is the unicorn. There are, if you're an accounting staff and you want to work, if you're a CPA and you want to work at a firm, those senior levels are harder to find. So again, kind of think about it, it's like, and this is kind of going to go why do firms should not be laying off, but it's expensive. So if someone leaves and if you have to replace them, not only are you going to have to train them, right, that new person who's coming aboard at the senior level, it's going to be expensive to hire, right? By the way, if you say to me, hey, Tchaikovsky, I'm a CPA with 3 years of experience at a big 4 firm. I want to go to a smaller accounting firm, and this is the one I want to go visit. Go direct, right? I can make an introduction for you, but go direct. I don't charge a recruiting fee to the accounting firms, but go direct. And because if you can basically get them to avoid that 30% fee, then it might mean more money for you later on. So again, over here, when it comes to referrals, that's also a way that both first-year associates and more experienced associates are hired. Indeed.com. If we go on to Indeed, we're going to see a lot of different jobs that are out there. So the thing that you should be taking away from this is that when you bring aboard someone, right, to kind of go through and you're bringing aboard someone, you're making a huge investment in them. So these accounting firms, when they hire somebody, they've got to train them. They've got to, hopefully they become more productive over time. And by the way, these rates are probably totally unrealistic. I think managers probably bill out closer to $300-400. Again, it just depends on the client and if it's public, not public, big 4, smaller firm. So again, when you're kind of going through and looking at all of this, it's really expensive to hire people because it's like you're taking away from more experience time. These firms are investing time in terms of training people. So you've brought these people on board, and remember, the biggest cost against this audit engagement is going to be the employee cost. If it's the facility rental, you have a problem. Because if you have this beautiful office space, that's great, but the office space can't perform the work on an audit engagement, right? So the employee cost is generally going to be the most expensive part, and going through the cost of training your people so that they're productive on engagements, it's expensive. Now, performance terminations. Have I been fired? Oh yeah. I've been fired several different times in my career. I've never been fired by like Donald Trump or like on The Apprentice, but I've been fired, and it's nothing bad happened. There was just, differences of opinion, and I probably deserved it, but that's okay. And how do employees get terminated? Let's kind of go through this. So the first question is that, and this is not a layoff, this is a performance termination. You're working in an accounting firm, and all day I'm playing Pokemon Go, right? I'm trying to basically catch them all day. Yeah, I'm probably not going to last that long, especially if I'm on the firm's Wi-Fi, because they can track my activity, right? So, or if I'm like being filmed at while I'm on screen, right? So you're going to be getting evaluated, right? And how am I evaluated? Well, part of it may be on productivity. If I was given a job and it took 100 hours, but I came in at 200 hours, and if it was something, it's my second time doing the work, that's going to be a problem, right? And generally with any type of, we'll talk to HR professionals, but if you are going to terminate someone for cause, you can terminate someone at any point in time. It's just that you risk getting sued as an employer, especially in California. So, and you also, if you terminate someone, you're not only going to have issues in terms of the actual termination itself, but there's something called Glassdoor. And Glassdoor, people go up and they start typing away these reviews. And this is not a good look for the firms, because then when someone goes to do their due diligence on the firm, they're going to be saying like, well, do I want to work at this company? Their evaluations are terrible. So what do I kind of go through and do? So when you evaluate employees, and it's really important for you to understand, how often am I evaluated? How am I going to be evaluated? I can expect that if I'm at a larger firm working with different people, I'll probably get a lot of different evaluations. Every firm does it differently. However, with our current generation coming up, they are very careful about how they're going to give you feedback. And if they're not, they're making a huge mistake, because we'll talk about that in a moment or on the next video. But when you are giving feedback, you have to really go through and say, well, why is, here's something that you're having an issue with, and this is or actually take that back. It's, you say, this is something you're doing good, but this is something that we need to go through and work on. And I would say, if you're giving a criticism, they need to have specific examples in terms of how they're going through and doing it. So again, when you're going through, and by the way, my little tip for you is that if you are having a lot of evaluations by the accounting firms and you're worried about it, you get a hold of the copy of the evaluation, right? Which will say, poor, fair, good, excellent, or whatever the ratings are. And you go to your senior and say, hey, look, I want to get all excellent. So what am I going to need to do to get that? By you talking to the senior about what I'm going to have to do to get perfect evaluations, you're basically putting it on them that if they give you something poor, but they didn't tell you about it, now that looks bad on them. So have that meeting. If you are getting evaluated, have that meeting with your senior before you go through and start. That was actually advice that was given to me back in 92 by a guy named Alatamian. Awesome dude. And he's now a CPA. I think he's living up in LA. I haven't touched base with him in a while, but great guy. That was the advice he gave to me, and he was absolutely right. That saved my behind. So again, so when you're going through and kind of like looking at evaluations, it's like, that's going to be the route one for the performance termination. If this person is not doing what they're supposed to be doing, that can be a problem, right? And engagement productivity, this is again going back to this part over here, is the staff being productive? And when you look at just engagement productivity by itself and chargeable hours, right? That's one factor, right? Is that, and again, when you're looking at Moneyball, and the whole kind of part of that was looking at things like on base percentage, like you don't look at just hits. You're also looking at, well, how often does that person get on base through a walk? Now, I know most of you are not baseball fans, but what this would be is like, oh, when I look at Bennett's been very chargeable, very billable, and we're paying him a lot of money with the overtime he's working, but he's charging the clients and the clients are paying. So I'm not going to let that person go because that person is making money for me, right? So if I'm letting someone go who is really good, that's going to kind of be a problem, right? But if someone's not productive, right? So if they say, okay, we need to do a headcount reduction, probably one of the first places they're going to go through and look is they're going to look at how chargeable you've been as a staff person. Are you chargeable? Are you how are you working with others? Are you doing good work? Like, what's going on? And this kind of goes back into, you can be terminated if you say the wrong thing to a client, or if you go to a client and you start harassing the employees, they're not going to hesitate to fire you. And that's what it is. If you're drinking on the job, if you're driving a golf cart into a lake, I heard that happened at some large firm retreat where a staff member or an intern took a golf cart and drove it in the lake. So, and by the way, don't drink on the job. Don't, drinking with coworkers and that social lubricant. It's like, don't do it. I would kind of keep those separate, and we'll talk about that in part 2 of the video. And, again, these are normal performance terminations. And what's really important is why they would want to call something a termination versus a layoff can have to do with perception as well as employment insurance, right? So let's kind of take a look at this from the employer side. If I terminate someone from a performance, right, what does that mean? Well, it means that the people around that person said, oh my God, this person wasn't doing anything. Finally, they got rid of them. So that's a termination. Now, if I go and say that someone's laid off, this is tricky because now everybody around that, oh my God, he just got laid off. It's like, oh boy, am I next? And this is where we get into the layoffs, which is really the last resort. Do they happen in public accounting? The answer is absolutely they do, right? And when I was going through where there seemed to be a lot more CPAs than there are today, they called it the Easter parade. Right after busy season, they would say, okay, we've got all of our work done, so now I'm going to let everybody go. And the challenge with doing that today is that you can let people go, but then you've got Glassdoor, social media, you got all this stuff, and that's going to be a problem. And there was a local firm who went through and did a layoff of employees. And I can tell you right now, they regretted it because they were end up acquired by another firm, and they had to integrate new software. They couldn't hire anybody. So everybody who remained after they did the layoff was working tons of hours. A lot of people quit. When you do layoffs, you have to be really sure that you're going through and it's like, okay, this is an absolute last resort. Because remember, when you lay off a staff, what's happening? All this time you spent training and mentoring them is going out the window. And, it happens. It can happen, though, because if I lose a major client, they go to a different firm, right? This is why it's so important for the partners to be going out and getting that business. If somebody basically goes through and leaves, or if the client leaves, and I have to basically go through and do layoffs. Now, for the employers, what you want to be going through and doing is that if you do decide to lay off staff, and this is really important to say, is that you better cut deep, meaning that you don't do it, oh, I'm just going to lay off 10% this week. I'm going to lay off 10% another month from now and another 10% in month 3. The reason why you don't do that as an employer is because people are going to be looking around them, right? Going, what's happening here? You're better to cut it all at once. Now, this kind of creates problems from a labor law perspective, right? There's something, I think it's still in effect, called the Warren Act. Again, this is probably showing how the old Bennett is here, because I've been out of the game for a little bit in terms of with labor law, but I would contact an employment attorney and make sure that if you are going to plan on doing layoffs, that you have to basically make sure you're doing it in a certain way. And that's all going to be depending on state law. But if you don't cut deep, the staff are going to be looking around each other and say, am I next? I guess it's time for me to polish, wax on, wax off that old resume and get that LinkedIn updated, say open to work, and let's get it rolling. Right. So this is something, again, why it is an absolute last resort because of the consequences on social media. Right. Again, termination, if the person deserved, most people in the office are going to know if someone deserved to be terminated. Right. But again, layoffs are very different because that means that someone says, am I next? And that's why you have to be. And also you have the problem too, is that if you're doing layoffs and the work level's the same, now all those people that are remaining there are pissed because it's like, wait a second, now there's less people to do the work. Like, what's going on? And again, you'll see that there have been some layoffs recently, but a lot of it, we're in a recession, or I guess, I'm not sure if what you would call it. We're in something that's not as robust as it was a year ago, but definitely with interest rates that are higher. This again is September 2023 with higher interest rates and everything else. And again, when you kind of go through and look at this, it's like the very last thing you want to do as an accounting firm is lay off staff. It is absolutely the worst thing you can do. And that's why you have to be careful in terms of things about overhiring, right? If we overhire, we don't have things for our people to do, then those partners are going to have to sit there and say, hey, wait a second, we got to keep these people busy. What do we do? How do we get them? How do we keep them engaged? How do we keep them from not leaving? Right. And the other kind of thing over here is like office politics. And the one thing I want to kind of say about this is that, getting along with others is really, really important to do. And one of the things, and again, I'll kind of talk about this in part 2 of the video, but one of the things I would just kind of say to all of you is just like, have a consulting mindset, go in, do great work. And we'll talk about that in the next video, how to do great work. And kind of try to stay out of like those office politics, because if a firm is smart, they're going to basically be saying, okay, in terms of productivity, this should be the main factor, is how well is somebody billing? How well is somebody going through and making money for me? If it's because they like someone or something else like that, that could be a problem. However, if they have a staff person that they think, oh, this person could ultimately become a partner because he brought us in a client, then that person might stay. Because if you as a staff person bring in a client to the firm, and if you end up getting laid off, what do you think that client's going to say? Oh, wow, Bennett was laid off and he brought us, if I'm that client, wait a second, you just laid him off, so I don't really want to do business with you anymore. You have to be, it can be very, very political. So there's a lot of different things that go into like different types of layoffs, right? So again, it's a last resort because the cost of the mentoring. So layoffs, do layoffs happen? Sure. Is it advisable? Absolutely not. You don't want to lay off staff because of consequences to your reputation on social media. There's just a lot of things why you do not want to do layoffs. And there you go. All right. A couple of things just to kind of remember, and I'm just kind of putting this in here, is that you are an at will or at. Wow. I got like a Empire Strikes Back. Wow. And at will. I almost had a Star Wars reference, an at walker. You're an at will employee. You can be hired and fired at a moment's notice. So just remember, you are expendable, not expendables 1, 2, 3, or 4, but you are expendable. You're not that kind of expendable, but you are expendable, right? And it's just the reality of working in an accounting firm. Now, where you won't be an expendable is that if I've been bringing in clients into the accounting firm, that's like, uh-oh, not sure if we can really fire that person or else we'll lose these clients. Okay. And this is something just also someone said once when I was at some of these different seminars, and they were absolutely right, which was you will ultimately be sued as an officer or director of a company. If you're privately held or publicly traded, especially if you're a publicly traded company, you're going to ultimately be sued. And similarly, you will more than likely be laid off or terminated at least once in your career. Like that's been me. So again, it happens. It shouldn't be a shock. It just, these things sometimes happen. It's oftentimes going to be out of your control. Sometimes it's in your control, but oftentimes it's going to be out. Other kind of thing over here is, remember, you're not that important. And I don't mean to say that you're not. You are important. We love you. But to a firm, the firm, if you leave an accounting firm, the firm will survive. And this is going to be more of our focus in part 2. I would say, though, that as CPAs, you should be giving at least 2 weeks notice. Now, if you give 2 weeks notice and the firm says, Bennett, give me your keys, give me your everything else, go get away, it's like, okay, thank you. I'll just take that extra time off. So again, being kind and giving those 2 weeks notice really, I think as a CPA, remember, you're going to be seeing some of these people again. And the other kind of thing I just want to go back and mention really quickly, going back to here, why are layoffs not a good thing to do? If you laid off 10 people and they become a CFO of another publicly traded company, or they had a bad experience with that accounting firm, guess who's not getting that business? That accounting firm. Like, it's probably like a partner walks in and they see a former staff that they laid off who's now the CFO. It's not going to be a good look, right? So again, reason why are layoffs the absolute worst possible thing to do is because when you create these relationships with staff people, it's like you have to kind of basically, it's their relationships, and you want to keep that business relationship going for a really long time. And the last thing, just to kind of another kind of thing, is that if you're looking for a family and affection and a workplace environment, it's probably not a healthy place to kind of go through and do that. If you're looking for a, and there's a line, I think, from the movie Wall Street, like where Gordon Gekko says, if you need a family or friend, get a dog. I'm not saying to go get a puppy, although a puppy would be great for this video. But again, if you're looking for a workplace, if you're looking for family, or you're looking for like that kind of, and this is a little bit more off topic, but this is going to get into when we kind of go through and start talking about part 2 of the video series. Like, your workplace environment is a place for you to go in, to do a great job, get paid well, and go home and spend time with your family. Right? The workplace environment, to kind of basically supplement those family relationships, can kind of be, I don't want to say it's dangerous, but it may not necessarily be healthy, because someone that you're a peer with could all of a sudden become your supervisor, and now they have to go through and discipline you or terminate you. So again, I would just kind of keep that in mind as you're looking at this. And thank you. So this is the end of part 1 of the video that I'm doing here. I will be coming up with a part 2 shortly. But if there's any other videos you'd like to see, please feel free to leave a comment. I look forward to seeing you on future videos. Have a great day.